This is Matthew Cratter from Trade University, and today I want to answer the question, why can't we just cancel all U.S. debt? So as we all know, the U.S. has this enormous pile of debt. It recently exceeded $30 trillion worth of total public debt, and this doesn't even include all the off-balance sheet liabilities like Medicare and Social Security. Our debt as a percentage of GDP is extremely high. It's currently around 123%. We can see in the late 70s and 80s it was closer to 30%. So it's very difficult for the Fed to raise interest rates, as we've been saying, when there's so much debt in the system. Things start blowing up. We can see the stock market selling off and mortgage rates spiking just from the Fed's last few months of hawkish action. The problem is if the Fed hikes rates too much, the U.S. government itself could reach a point where it can no longer pay the interest rates that are being required by the free market for its debt. The central bank, the Fed, has been keeping those interest rates unnaturally low. So I had a good question from Danny Boy asking, why can't the Fed just forgive or delete some of that debt? When the Fed sells a U.S. government bond, a treasury, to reduce the size of its balance sheet, that's what it says it's in the process of doing. This is what's called quantitative tightening, or QT. You may have heard of it. Someone else needs to buy that bond that the Fed is selling. Now, usually the Fed just allows the bond to mature. You'll hear this expression, allows the bonds to roll off its balance sheet. That just means that it matures. But the US Treasury pays off that maturing bond by issuing a new bond because there's not enough money coming in from taxes, and there hasn't been for many decades. And so the US government needs to issue new debt to pay off old debt. And so even if the Fed is not buying that new debt, someone else needs to buy that new bond. So then the question is, well, why do we need to do this? Why can't we just cancel this particular government debt? If you're finding this video helpful so far, be sure to hit that subscribe and like button. So what's the big problem with canceling some or all U.S. federal debt? Well, this is the problem. A U.S. Treasury or a government bond is a liability of the U.S. government. In other words, it's a sign that the U.S. government owes someone some money. But on the other side of it, it's an asset to someone else. It's an asset on someone else's balance sheet. And one way to think of this is to think of an individual who's close to retirement. John Smith, we'll call him, 65 years old, has 20% of his retirement in stocks and 80% in fixed income. We'll just say it's all in Treasury mutual funds, which are mutual funds which themselves buy and hold U.S. Treasuries or U.S. government debt. If you were to cancel those Treasuries, all of a sudden you have a situation where John Smith cannot pay for his retirement. His net worth goes down by 80% because you've just canceled those Treasuries. Now, this could have all huge repercussions on John Smith's ability to pay his mortgage, on his consumer spending patterns, etc. So you can imagine the ripple effects of doing this to a lot of investors, whether they're retirees or whether they're earlier in their retirement savings. The same thing happens at the corporate level. So let's say we have Corporation XYZ. It has $5 billion worth of U.S. Treasuries on its balance sheet. These are its assets that it owns. And it's issued $1 billion worth of its own debt, its own corporate debt. That means it has a book value. We'll just say these are the only assets and liabilities. You just take assets minus liabilities. So it has a book value of $4 billion. But if you cancel those treasuries, which are assets on this corporation's balance sheet, all of a sudden its book value goes from positive $4 billion to negative $1 billion. It now has a negative book value, which is usually fairly dangerous for a company unless it has running a certain playbook where it's financing its inventory. But for the most part, you can see how this would also blow a giant hole in the balance sheet of a corporation. Now let's pretend that corporation is instead a bank that holds these U.S. Treasuries, but holds them in a highly levered manner, is using a lot of its own debt in order to leverage up returns. If you cancel those U.S. Treasuries for enough banks that they have on their balance sheets, you end up with a systemic crisis. You end up with a complete banking crisis. Now we can see here that these are the major foreign holders of US Treasuries. We have Japan, we have China, we have the UK, Luxembourg, etc. And we're looking at trillions and trillions of dollars of treasuries. So if you cancel these treasuries as well, you end up blowing a giant hole in the balance sheets, in the net worths of all of these different governments and their central banks. So canceling US debt is the real problem. It's the US government's liability, but it's someone else's asset. And canceling it really would constitute what's called a hard default. It would blow a giant hole in the balance sheet of millions of households and corporations, pensions, and countries all around the world. And so doing this would really cause an instant global financial crisis of the kind we really haven't seen since maybe the 1930s. So instead, and this is why I emphasize this in my videos, instead the U.S. is going the path of a soft default. So canceling the debt would just be a hard default where you just don't get your money back that you've invested in treasuries. A soft default is when the U.S. government or U.S. Treasury pays off its old debts with devalued dollars. So if you invest $100,000 in U.S. Treasuries, you buy a 10-year note and it matures, you definitely get your $100,000 of principal back and you've been paid interest all along. But if the U.S. government is devaluing the currency by having the Fed print a lot of money, that $100,000 that you get back has lost some purchasing power and it doesn't have the same value that it did before. So maybe let's say when you first invested in U.S. Treasuries, that $100,000 was able to buy you a quarter of a house, a $400,000 house. Now, because housing prices have gone up so much as the U.S. dollar has been devalued, maybe now it only buys you 20% of a house. In other words, $100,000 buys you 20% of a $500,000 house. And so this is what a soft default looks like, where a government pays off its debt using its devalued currency. If you devalue the dollar enough, those government debts, we saw the huge government debt to GDP levels, those government debts don't seem as large because as you inflate your way out, you grow the size of the economy in nominal terms, you grow nominal GDP, you grow the tax base, everyone's salaries go up, not because they're getting any richer, but because they need to be able to pay for gas and groceries. So it's a way of growing the nominal value of the U.S. economy and increasing the taxes that everyone pays. And in that way, you can bring down debt as a percentage of GDP. Even if the debt's staying the same, if the GDP is growing, then this fraction, this percentage gets smaller. So the situation we're in, and as we're discovering, and as I've been saying in my videos, the Fed cannot run the Paul Volcker playbook of the late 1970s, early 1980s with 123% debt to GDP levels. It ends up blowing things up, as we're seeing with the stock market, and eventually it ends up bankrupting the government, where the government cannot pay the interest on its bonds without borrowing new money to pay that interest. And we're really already in that situation. So what we're doing instead, what the path that's been chosen, the long-term path with some volatility around it, is to inflate our way out of our debt. So we can see that the latest CPI inflation reading was 7.91%. If we look at the 10-year note, it's currently, as of Friday, yielding about 2.71%. And so if we calculate the real return on that, or in other words, the real interest rate, you just take the nominal rate, subtract out inflation, and you end up with minus 5.2%. So if you're holding a U.S. Treasury, all else being equal, if its price doesn't move, or if you hold it to maturity and CPI inflation stays the same over that period of time, you end up with an annual loss of 5.20%, annual loss of purchasing power if you hold the U.S. Treasury. If you hold it for 10 years, you can imagine how this compounds. So this is what negative real rates are. They're a sign of a stealth default or a soft default, where you get paid back your money by the government. The government's good for its debt, but it pays you off with devalued dollars. And in this way, it steals from its bondholders. It steals from its citizens. It steals from corporations and governments and everyone who holds its bonds. The good news, negative real rates are very good for stocks. They're very good for real estate and other scarce assets that cannot be printed up by the government. Government can print up endless U.S. Treasuries and endless U.S. dollars. Government cannot print up endless real estate, endless gold, and most especially endless Bitcoin. So it's only just a matter of time until the Fed reverses policy and turns the money printers back on. It's trying this experiment to see how much it can shrink its balance sheet, how much it can raise interest rates. But when a recession hits, when we get a stock market crash, when the plumbing of the U.S. financial system, maybe the liquidity of the US Treasury market gets worse, at this point the Fed has to reverse policy and turn the money printers back on. But I think things are going to get quite ugly first. The Fed is running this bluff, pretending that it can run the Volcker playbook and be very, very hawkish and raise rates and shrink its balance sheet. But it really cannot, as we are seeing and as we will continue to see. At some point, probably in the next few months, the Fed's going to have to reverse course, and they're not going to be able to carry through on this. There's still too much leverage in the system to raise interest rates and to shrink the balance sheet as much as they want to. So the Fed's in this weird position where it has to pretend like it doesn't want inflation, but inflation is really the only thing that can save the Fed and bail the U.S. out of its debts. Just canceling the debt or a hard default will not work because it ends up instantly, overnight, blowing up the global financial system. This is why housing prices will continue to go up over this decade. This is why stock prices will continue to go up. And most especially, this is why Bitcoin prices will continue to go up for the rest of the decade. It's this soft default. It's this transition away from the US dollar global financial system that will send Bitcoin first into the hundreds of thousands of dollars per Bitcoin, and probably within 5 years to $1 million or more per Bitcoin. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.